guys, let's talk about UK interest rate updates with mortgages.
The basics made simple. Interest rates are everywhere, quietly influencing our daily lives, whether we notice them or not. From the moment you open a bank account to the day you consider buying a home, interest rates are at play, shaping your financial journey. Interest rates are simply the cost of borrowing money or the reward for saving it. Think of them as the price tag attached to money itself. When you borrow, you pay extra for the privilege. When you save, you earn a little extra as a thank you from the bank for letting them use your money. For example, if you borrow $100 at a 5% interest rate, you'll pay back $105. That extra $5 is the interest, the cost of using someone else's money for a while. It might not sound like much, but over time and with larger amounts, interest can really add up. On the flip side, if you save $1,000 at 2%, you'll earn $20 in a year. It's your reward for letting the bank use your money to lend to others. The more you save and the higher the rate, the more you stand to gain. An interest rate is always shown as a percentage. It determines exactly how much you'll pay when you borrow, or how much you'll earn when you save. Even a small change in the rate can make a big difference over time. When you borrow, the higher the rate, the more you pay back in total. This is especially important with things like credit cards or loans, where high rates can quickly make debts grow. When you save, the higher the rate, the more you earn on your money. That's why people shop around for the best savings rates. They want their money to work as hard as possible for them. This dual nature of interest rates affects every major financial decision: buying a house, saving for the future, or using a credit card. Whether you're taking out a mortgage, planning a holiday, or just managing your day-to-day spending, interest rates are always in the background, influencing what you can afford.
Let's subscribe.
Understanding interest rates is the foundation of smart money management. It helps you make better choices, avoid costly mistakes, and get the most out of your hard-earned cash. You don't need to be a maths whiz, just informed. Knowing how interest rates work gives you the power to ask the right questions and make decisions that benefit you in the long run. Remember, interest rates are always working in the background, shaping your finances, whether you're aware of them or not. They can be your friend or your foe, depending on how you use them. The key is knowing how they work for or against you. By paying attention to interest rates, you can make smarter choices, avoid unnecessary costs, and even grow your wealth over time. Get this right, and you're already ahead, well on your way to mastering your money and building a secure financial future. So, who actually decides these all-important numbers? The main UK interest rate, the bank rate, is set by the Bank of England's Monetary Policy Committee, or MPC. This group of 9 experts meets every 6 weeks to review the economy and vote on whether to raise, lower, or hold the rate. Their main goal: keep inflation at 2%. Their decisions ripple out, influencing the rates you see on mortgages, loans, and savings. The MPC is independent from government, ensuring decisions are made for long-term stability, not short-term politics.
Let's subscribe.
For most people in the UK, buying a home is one of the biggest financial decisions they'll ever make. It usually means taking out a mortgage, essentially a long-term loan to help you afford your dream home. But what many people don't realise is just how much interest rates can affect the total amount you pay over the years. Even a small change in rates can have a big impact on your monthly payments and your overall budget. Fixed-rate mortgages are a popular choice because they lock in your interest rate for a set period, often 2, 5, or even 10 years. This means your monthly payments stay exactly the same, no matter what happens to the Bank of England's base rate during that time. It gives you peace of mind and makes it easier to plan your finances, since you know exactly what you'll owe each month. But when your fixed term ends, things can change quickly. Most people are automatically moved onto their lender's standard variable rate, which can go up or down at any time. This can make your payments unpredictable and sometimes much higher than before. variable or tracker mortgages are directly linked to the Bank of England's base rate. If the base rate rises, your mortgage payments will go up too, sometimes by hundreds of pounds a year. If the rate falls, your payments could go down, but there's always a risk they'll rise again in the future.
Please
For example,
subscribe.
even a 1% rise on a $200,000 mortgage could mean paying around $2,000 more each year. That's a significant increase, especially when household budgets are already stretched by other costs. That's why it's so important to understand what type of mortgage you have and to plan ahead for any changes. Reviewing your mortgage regularly and seeking advice can help you avoid nasty surprises and keep your finances on track. The Bank of England's Monetary Policy Committee makes decisions that can affect your mortgage and your budget almost overnight. Staying informed and being proactive can help you manage your payments and protect your home. It's not just mortgages. Interest rates affect all borrowing. When the base rate is low, loans and credit cards are cheaper. When it rises, borrowing costs jump. A few percentage points can add hundreds or thousands to a loan over time. Credit card rates usually follow the trend, making it more expensive to carry a balance. In a high-rate environment, managing debt becomes even more important. Shop around and pay off what you can. Higher interest rates are tough for borrowers, but great for savers. When rates rise, banks usually offer better returns on savings accounts. Your money grows faster. But banks are slow to pass on these increases, so shop around for the best deal. If rates are low, your savings might not even keep up with inflation, so consider your options carefully. The interest rate environment should shape your saving strategy. Don't assume loyalty pays. Move your money for better returns. Make your savings work as hard as you do. Why do rates change? It's a question that affects everyone, from families planning their budgets to businesses making big decisions. Interest rates are set by the Bank of England's Monetary Policy Committee, or MPC, and they play a crucial role in shaping the UK economy. It's all about controlling inflation and keeping the economy stable. When prices start rising too quickly, the MPC steps in to try and slow things down, making sure your money doesn't lose its value too fast. If inflation is high, the MPC raises rates to slow spending and cool prices. Higher rates mean borrowing costs more, so people and businesses tend to spend less, which helps bring prices under control. But if the economy is sluggish, with growth slowing and people spending less, the MPC can cut rates. Lower rates make it cheaper to borrow, encouraging people to take out loans, buy homes and invest in businesses, which helps boost economic activity. It's a delicate balancing act. Too high and we risk recession as spending dries up. Too low and inflation can spiral out of control, making everyday goods more expensive for everyone. The MPC constantly reviews data, forecasts, and global events to find the just right rate. They look at jobs, wages, prices, and even what's happening in other countries to make their decisions. Their decisions affect everyone: borrowers, savers, and businesses. Whether you're saving for retirement, buying your first home, or running a company, interest rates shape your financial choices. Understanding how and why rates change helps you see the bigger picture and make smarter decisions with your money. In many ways, interest rates are the economy's steering wheel, guiding the country through good times and bad, and helping keep everything on track. So, what should you do with all this? Know your mortgage type, and when your deal ends, plan ahead to avoid costly surprises. Check your loan and credit card rates. Switch or consolidate if you can save. Don't let your savings languish. Hunt for the best rates and move your money if needed. Every percentage point counts. Stay informed, review your finances regularly, and act when rates change. You don't need to be an economist,
Thank you
just
for watching,
proactive.
guys.
With the
Subscribe
right
for daily
moves, you
news.
stay in control of your finances.